Hi, this is Patrick Bowen. I'm joined today by David Mccoy, Life Product Research Consultant, and Seth Detert, Director and Actuary, the Life and Annuity Product Portfolio at Securian. Gentlemen, welcome.
Thanks.
Good to be here.
Great. Well, as we get started, I wanted to ask you, how long has Securian been in the index universal life space, and why do you see it as such a good consumer value?
Yeah, so I'll take this one. So Minnesota Life is who we originally jumped into the index universal life market as. Today we're Securian Financial, but the first product that we launched was our Eclipse contract back in the fourth quarter of 2006. So we've now been in the IUL market for roughly 14 years. And actually the Eclipse contract had been available for sale all the way up until the end of 2019. So, even just our original contract alone had been available in the IUL space for, just under 14 years. So we've been around for quite a while. We currently offer, both single and joint life IUL policies. So we've continued to expand over that time. But the benefit really of the IUL products and why we really enjoy this space and we really think this is a great space for us to be in is, it's a great product for consumers who are looking for not only protection, but who are also looking to potentially supplement some of their retirement needs. So, the benefits of the IUL contract is you don't have to give up the total upside that maybe you would with like a fixed traditional universal life contract, because you still have some of that upside potential. But at the same time, you do have that downside protection as well with typically you're going to see the 0% floor. Sometimes it's a little bit higher than that, but nonetheless, having that downside protection is a great option for the clients who maybe don't quite want to get into that variable product. Maybe it's a little too aggressive for them. This IUL product is going to be a great fit for them.
Great. I'll just add a couple things there too. As David mentioned, right, we were founded in 1880. We've been around for a long time. We have about 375,000 policies in force with about $214 million of death benefit. And as David mentioned, our first IUL contract was Eclipse. And that was our first entry into the BGA IMO space. We had predominantly been a career carrier up until that point. And that IUL has fueled consistent growth for us over the last 13 years, and up until like recently, where we're also seeing some pretty good growth in our linked benefit or secure carrier universal life product.
Great. Well, it sounds like, really a long-standing history in the index universal life space. I would ask, back in 2015, when AG 49 first went into effect, since that time, have you incorporated multipliers into any of your IUL products?
So we did have a couple multiplier products on our Orion contract, which was actually the successor to our original Eclipse contract. They were fairly modest in terms of what you see today. It had a charge of about 1.5%. So not nearly as high as some of the charges that you're seeing out in the industry currently. However, we did have, again, a couple multiplier products or a couple multiplier indexes on that contract. Now, because we didn't really feel good, I guess, about where the industry was currently trending with the higher fee and higher multiplier designs. So we did kind of step away from that a little bit. So our current product is going to be our Eclipse accumulator contract. And we did step away there. We took kind of a step back and said, we don't like where the industry is currently trending necessarily. So we're going to go the opposite route. And the opposite route that we went was low cost, simple, easy, transparent, that type of a product design. Because when you really think about it, an IUL contract is complex in itself. And when you start throwing on some of these really complex product features, then it really becomes kind of an issue potentially for the consumer to totally understand what it is that they're purchasing. So we just decided, let's take a step back. Let's go the other route. Let's go that simple, low cost, transparent route instead.
Great. Do you see too then, because of that there'll be little impact then on your products as you move forward?
Yeah, so the impacts to our contract moving forward now with the new reg, it is going to be pretty minimal. There's going to be A couple changes that everybody, regardless of what they have on their contract, they're going to be impacted by. So, the reduction of the loan arbitrage down to 50 basis points, that'll impact it. But again, that impacts everybody. Some of those things. But overall, because we don't have those multipliers or some of those highly aggressive bonuses, the impact is going to be really just kind of following what the new changes to the loan for the most part are going to be. And then obviously making sure that we continue to adhere to the max illustrated rates that AG 49 dictates that we're allowed to illustrate.
Great. Well, Seth, I understand you had some personal involvement with the AG 49A task force. Is there anything you might want to share with us about that experience and maybe a little bit about the process that led us to this point?
Sure, yeah. Securian Financial was an active participant in the AG 49 calls with the Life and Annuity Task Force. We took the position, as David mentioned, that the current illustrative practices for multipliers were not transparent and would lead to potential issues for the industry down the road. Of major concern for us and a group of carriers that felt similar to us was around the constant illustrated rate for IUL illustration. So which effectively means, right, that if you run an illustration, most people run it at the same rate the whole time. So whether that's 6% or whether that's 5%. And when you do that in the context of a multiplier illustration, you're getting effectively you're getting a positive payoff. So if you pay the 4% or the 5% charge and you get a 6% illustration on your money, you're making that 200 basis in every year. And that's just not going to happen in real life, right? I mean, you can do a study and, even the last 10 years aside, you still generally get, a negative return or a flat return from the index anywhere from a quarter to a third of the time, depending on which period you look for. So it's just unlikely that you would get that positive payoff in every year of the illustration. And so we just didn't believe that consumers really understood that. We didn't believe that consumers understood how charges were coming out of their contracts to pay for this upside benefit. And it was just going to lead to issues down the road. And so again, on behalf of a coalition of insurance that had felt similar and had similar concerns, yes, I drafted and helped sponsor several comment letters to the Life and Annuity Task Force. It took us like over 12 months from the first discussions to the time that AG 49 was actually adopted by the task force. I want to say too, I was really happy with the industry response. I mean, I will admit there was a little, back and forth and candidly fighting, kind of both sides of where the people were. But once the Life and Annuity Task Force made the direction of the regulation that they were searching for known, I would say both carriers with multipliers and carriers like Securian that weren't currently offering one, definitely, pulled together and worked together and collectively developed the best regulation we could, acknowledging that perfection probably wasn't a realistic outcome, but, trying our best collectively as an industry to meet the desires of the Life and Annuity Task Force.
Great. Well, and I think you kind of covered there too a little bit about some of the positives that could come from this and maybe addressing some of the concerns. Are there anything that strikes you as perhaps concerning from an unintended consequences standpoint from AG 49A going into effect?
Yeah, sure. As with any regulation, it's not perfect. It's not bulletproof. There are certain interpretations that people will be able to make out of the sections of the new regulation that will cause some differences in the industry. And frankly, right, I mean, there are a lot of smart people out in the industry and innovative people. New features will emerge that weren't considered, by the regulation when we were drafting it. But we still believe it's a better outcome than staying the current course or staying on the original AG 49. Again, we were advocating for progress over perfection. And, taking 12 months to deliberate it was long enough. And we just felt like we needed to move forward. And that's why we're advocating for a change. I know David had some thoughts too around some of the positive sides that I'll kick over to him to talk about.
Yeah, some of the positives, we did kind of touch on them a little bit, but, ultimately, and this is really what we were kind of shooting for in terms of, where the regulation was going, is that we're hoping that this makes it easier for the consumer to understand what it is that they're purchasing. The last thing that we want is for a consumer to purchase a contract not knowing, the risk associated with this contract and being upset that that was what was sold to them. So, we're really hoping that the outcome of this regulation ends up being that there's, a better understanding from a consumer standpoint and an agent standpoint, to be totally honest, as to, how these products work and how some of these features may actually have an impact to the overall performance of their contract.
Great. Yeah, clarity is such a big piece of it, and to the extent we can make that clear for the BGA, for the producer, for the consumer. Anything Securian's doing specifically as far as the communication timeline out to your BGAs, producers, and ultimately consumers?
So we have actually we've sent our transition guidelines and, what to expect, I guess, from Securian with the December 14th timeline. So when the illustrations need to be run by, when it needs to be issued, all of that kind of good stuff. So that we have already sent out to the field. And for those of you who do business with us, hopefully you've already seen that to this point. But some of the other things that we've been continuing to do at the BGA and advisor level is we've really kind of tried to continue to take, and will continue to take, an educational approach on this. So we've done quite a few webinars, creating marketing materials, doing on-site presentations, at least when we could in the past year, to make sure that we're completely providing as to, as much as we can anyways, on what the impacts to the contracts this new regulation is going to have, as well as internally. So making sure that our own sales folks have a good understanding of what the impacts this regulation is going to have. So when they are going out and visiting our BGA friends or our advisors, they can have those great conversations with them to make sure that they're also helping provide some of the additional education as to what the impacts of the overall regulation is going to be.
Great. Well, I know this particular guideline didn't really affect in-force customers, but anything you would want to share on how Securian communicates to in-force customers, or will there be any mention of this to your existing book of business?
Yeah, with regard to the multiplier side of it, we do have limited exposure to some of the features that AG 49 is going to impact. But as David mentioned, right, our focus has been on education, and we'll continue to try to educate our financial professionals in the field about the risks associated, those features, and the changes as far as they go with AG 49. As of right now, and as you guys know, like people rely on in-force illustrations, probably is a lot of like the material after the fact. And so with AG 49A not applying to in-force, there will just have to be clear and, be in a position to answer the questions as things come up as to, why can I do this on this illustration, why I can't on this one I sold last year, and they might only be 6 months apart, right? Those sales, but we'll have talking points around that, and we'll try to be as clear and transparent with our field and financial professionals as we can be.
Great. Well, this has been really informative, I think, for all that have tuned in today. Is there any final thoughts you want to share with those who have tuned in?
So my big thoughts are going to be, again, we've recognized that there's been, really this trend that's gone towards this high fee, high multiplier product design. But our final thoughts are, we're very comfortable with the design of our products, and we feel good about the transparency that we're providing on our products. So we feel that we're in a great spot currently as a company from an IUL perspective. And we just continue to chug along in the IUL front, and we will continue to do so going forward.
Yeah, and with regard for me, right, I still think, IUL's taken a little bit of hit here lately with, the regulation coming out reputational wise, and with interest rates, going low and staying low, it's going to have impacts on caps and in-force contracts. But I still think that there is a strong place for IUL in the industry. There's still, the value proposition is still there. There might not be as much upside as there was back when people were earning, 4 or 5% on assets backing the general account, but there's still a good place and a good solid story around the index universal life contract that as David mentioned earlier, people that are looking for a little bit of upside but don't want to participate in any of the downside of the market. Maybe they're closer to retirement or just a more conservative investor. This product still offers a very strong value proposition for that. So we're still bullish on IUL going into the future.
Great. Well, Seth, David, I appreciate both of your time today. We're going to go ahead and kick it back to Nelba. Stay engaged.